Happy Monday, everybody. Welcome back to the Peak Wealth Podcast. My name is John Perry. I'm a Senior Vice President and Wealth Advisor for Steel Peak Wealth Management. I am happy to be here post the first college football weekend and NFL weekend. I've got happy news and sad news. The happy news being, we'll start with first, that my Steelers won their first game, and that, unfortunately, my Wolverines didn't do so well against Texas, but it's a long season, and we'll bounce back. Today, I want to talk about something that I'm getting a lot of questions about in the market right now, and I think it's incredibly important. We have a lot of things going on right now globally and domestically. We have an election coming up. Questions about when the Fed is going to start reducing interest rates. So you start, or at least I am getting a lot of inquiries from clients about, is it a good time to invest new money? Should we take profits or should we raise cash? And it kind of brings up that age-old investment question about timing the market. And it's something I love talking about because it's been proven time and time again that it's not about timing the market. It's about time in the market, okay? And I've been doing this again for over 30 years. And I don't care how good somebody is, whether they're Warren Buffett or, one of our, the well-known hedge fund managers out there, or Peter Lynch back in the Fidelity days. They didn't do what they do by trying to guess the market. The one thing that I will bring up is a very famous comment by Warren Buffett when he said, when people get greedy, get fearful, and when people get fearful, get greedy. And that has more to do with, the different cycles within the market when things get very high versus very low, or you have a big sell-off. But it's not about worrying about specific events like we have going on right now. Whether it's, again, the reduction of interest rates that should start this month in September, and the word on the street, and if you read what a lot of the analysts and economists are saying, they think we might get as much as 2% in rate reductions over the next 6 to 12 months. And that's pretty significant. That will have an effect on the market. And we also have an election coming up. And one of the things that going into an election that happens, and we're seeing it right now with all the volatility, is a lack of clarity. We don't know necessarily who's going to win. Even if it looks like somebody's going to win, it doesn't mean the other candidate isn't going to win, as we've seen in the not-so-distant past. But I'm starting to get comments from clients about, well, should we raise money ahead of the election? I don't want to invest money because I want to wait until after the election. And the bottom line is, whether it's major events, domestic or global, or just trying to time the market, it is better to just be invested in the market than try to pick your spots, okay? I have a couple of slides that are going to illustrate that. The first one is kind of like a timeline of the last 20 years of different major events and crises that happened globally. And if you see here, again, this is pretty appropriate because a few weeks ago when we had that big pullback and people were worried about recession again, and they started talking about that rhetoric, we had that less than a week long pullback, but it was pretty dramatic. A lot of the tech stocks sold off. But let's take a look at this. This is since 2000. All of these situations were times that people said, sell, get out of the market. Okay. Everything, if you look from the bottom left-hand side, you have Y2K, 9/11, the Afghanistan war, our financial crisis, Ebola, big job loss after the COVID crash. We had a ton of jobs lost, and then Russia invaded Ukraine. Okay, all of these would have been, any of them, reasons why people would have left the market, okay? Or thought that it was a good time to leave the market. But if you look at that chart, other than some dips and pullbacks, COVID really being, the most dramatic after the financial crisis, which doesn't even look that big on that chart. But what do we see that is uniform through this whole chart? The market went up, okay? And if you see here, if you invested $500 a month during this period, regardless of all these extraneous events that happen, and you just held on to it, $500 a month for 12 months for 20 years, you would now have almost $500,000, okay? That is incredibly dramatic. Okay, so it's not about timing the market. It's not about saying this event is so bad that the markets can't recover. And if anything, markets move more dramatically now than they ever have. If you look at the financial crisis, the market dropped, 08 to 09, almost 40%. Okay, very, very dramatic drop, one of the worst ever. It took 3 years for the S&P to break even after that. Long time, especially if you are somebody that is entering retirement or in retirement and you have a lot of investment, a lot of your money in equities, stocks. Let's compare that to what happened just most recently with the pandemic. From March of 2020 through the May time period, very quick, we dropped about 30%. Okay? By October of that year, of 2020, the market was back to even. Unheard of, okay? That is so dramatic, and that is because of how fast markets move today. Call it technology, call it the fact that information is so quick these days. And we ended up that year positive. That is incredible, okay? So again, staying invested even through these times of crisis. And let's remember, during the pandemic, it was global. It wasn't just here, okay? Cities were closed down. Businesses changed the way they operated. There was a lot of rhetoric about whether people would really go back and work in offices full time. A lot of businesses went out, whether they were retail, whether they were restaurants, okay? A lot of businesses not only struggled, but ended up closing. And still, the markets went up. And even the last couple of years, we had a terrible 2022 after interest rates started spiking, very dramatically, pretty much parabolically. We had one of the worst years all around in the last 30 years. It was only the second or third time, that the stock indices and the bond market together, each of them, were all down double digits. Pretty much unheard of. Rarely happens. But if you were scared and you left the market, you missed 2023 when everything was up double digits, where the NASDAQ, rebounded 30 or so percent. The S&P rebounded 20+%. Okay? So if you were trying to time the market, if you let fear dictate how you invested, you suffered because of it. I've got another chart that I think even more dramatically illustrates why it is so important to stay invested in the market. Okay. And let's just emphasize this again. Time in the market is more important. Okay. Right above me. Time in the market is more important than timing the market. This is a time period of market performance from 2001 to 2020. So let's think about what this encapsulates. The dot-com burst, pretty much all those things we just showed in the previous slide, but let's talk about the major ones. The dot-com bursting, bubble bursting, okay, the financial crisis and the pandemic, all right? So this time period had a lot of dramatic events in it. If you were invested in the S&P and you stayed invested in the S&P, the average return annually was 7.5%. All right? Now, here is where statistics are actually a valuable thing. So, over 20 years of investing, that's over 4,500 days. Okay? If you missed the 10 best days in the market out of these 20 years, your average return drops from 7.5 to 3.4. Let's just digest that a second, okay? 7.5 to 3.4. So you lost more than half of your average return for just missing 10 days. One of the things people don't realize is when you're going through dramatic pullbacks or downturns in the market, that is typically a time where you get a lot of dramatic positive days. So if you panic and you pull out, you're going to miss those up days that help you recover. Let's take this one step further. If you missed the 20 best days, 20 days out of 20 years, you basically lost all of your return for missing the top 20 days. Your return was 0.1%. Excuse me. And if we want to go even a little further, we'll skip all the way to the right side there. If you missed the 40 best days out of these 20 years, this time period, you had a negative return. Okay? That's how much impact missing those days would have had on 20 years of return. Okay? So again, this is saying that you were invested during these time periods, or this time period, but you missed these days. Whether it's 10 days, whether it's 20 days, whether it's 30 days, or whether it's 40 days. Okay? This is not statistical magic or anything. If you see on the bottom of this chart, this was put together by Bloomberg. Okay? So nothing to me emphasizes or states the case for staying invested in the market more than an example like this. Okay? I've been doing this for 30 years. I think I have a pretty good handle on the markets, but nobody can tell when there's going to be an event that short circuits trading for a couple of days because it's some kind of impactful information about a company, about a country, about something happening here with policy. So staying invested and having a plan, we've talked about that before. This is why I think it's very important to work with somebody, work with an advisor like myself, because there are times, and I'm getting the calls now, where it's important to have somebody to talk to hold your hand, and to sometimes play devil's advocate. Because I've had those calls already where somebody said to me, should we raise money? And unless there's a reason why you need the money, the answer I typically say is no. Okay? Certainly if somebody's in retirement and they have something they're going to be spending money on, and they want to make sure in a period of time, 6 months, a year, that money isn't affected by a pullback, okay, But for somebody who's investing for the long term, you don't make changes in emotional changes, knee-jerk changes. You don't pull out of the market simply because there's some short-term bad news. You might even think that if your candidate in an election doesn't get elected, and obviously I'm getting a lot of this type of commentary now, if somebody is in one party and they're afraid the other candidate from the other party is going to get elected, let me just inform everybody out there, markets go up and down for both parties, okay, in both types of administrations. You might have short-term noise when a new president is elected, or there are changes in terms of the Senate or the House, in terms of who has the majority, and how that relates to the political affiliation of a president. But markets go up and down regardless. And I'll even propose that Fed policy has a more important impact on how the markets perform than the president. Okay, the president himself has very, very little ability to impact the markets long term. In the short term, they can certainly say things that make the market more volatile. But in the long term, there are a lot of other things that are out there within an administration, within the government, and again with Fed policy. Let's just real quick look back at what happened over the 10-year bull market that we had. I will venture to say that bull market had more to do with Fed policy, okay, and keeping rates artificially low than anything a president did during or said or put into action. And if you want to see a further example of that, as soon as we started unwinding it and as soon as we started raising rates and had to do it dramatically, that's what created 2022. That's why that was such a bad year. Because to offset those artificial low rates that we had for 10 years, rates had to go up dramatically in a short period of time. Okay, that was Fed policy. That wasn't in a particular administration's policy. Okay, because the Fed works independently of the president or of the government, of the Senate, of the House. So that's really what I wanted to talk about today. We're heading into this time period now where we're getting closer and closer to that election, where we're going to hear more and more about each candidate's policies, where the market is going to get volatile. Because remember, the market is governed by behavior and emotion in the short term, and you're going to see a lot of swings. Again, that pullback that we had not so long ago had to do with people worried, traders, investors worried about a potential recession and the economy slowing down more dramatically than might have been expected. And once that fear dissipated in the next couple of weeks, the market started moving up again. Okay. And now you have other things that are potentially going to impact the market. This month, like I said, we should see the beginning of rate reductions on the Fed rate, and that will have an impact on the market. I think it'll have a more dramatic impact over whatever that policy by the Fed is going to be. If they say they're going to continue to lower rates to get to a certain point, like I said, there's a lot of rhetoric out there that they think it could be as much eventually as 1.5% to 2%. That will impact the market, I think, in the long run, more than pretty much anything else that's going on right now. So again, that's today's lesson. My name is John Perry. I'm with Steel Peak Wealth Management. Thank you for listening to the Peak Wealth Podcast. You can find our episodes on all the major platforms, on YouTube, on Spotify, and on Apple Podcasts. And if you want to get in touch with me, you can reach me at john.perry@spwm.com. You can see it right there on the screen. All right. Thank you, everybody, and have a great day.